老铁们，现在是2023年12月初。今天我们的视频访谈一个嘉宾，通过8年从物理治疗师变成拥有3000多单元的地产投资人，就让我们听听他的故事，看看他是如何取得这样的卓越成就。在节目开始之前，别忘了订阅我们的邮件，关注高回报的公寓楼物业项目机会。What's up, my friends? Welcome to today's video. I'm thrilled to introduce our guest, Nic Espanet, who is the founder and principal of Flex Equity Group. Nic is a multifamily syndicator and investor with a remarkable journey in real estate. In almost 8 years, he got a tremendous profile of 3,500 plus stores. I have had the pleasure of getting to know Nic through the Brett Summer Apartments Investment Mentorship Program, where Nic served as one of the summer coaches. His insight and coaching has been invaluable to me. So you're going to hear about how he leverages his background and shifted in his late 30s and thrived to living a financially abundant life. Without further ado, let's dive into the story of Nic Espanet. Hey, Nic, welcome to the show.
Thanks for having me. I'm excited to be on with you today. How's your day going?
Oh, good. Yeah, busy as usual. Okay. Thanks for asking. Happy Friday, by the way.
Yes.
Do you mind telling the audience a bit more about yourself?
Sure. I'm Nic Espanet. I live in Fort Worth, Texas, which is part of DFW, with my wife and 3 daughters. But I went to school to be a physical therapist and did that for over 20 years, but started looking for something different. Mostly started looking for somewhere different to put my retirement funds, and thought I was going to do single family home, like fix and flips and things like that. But as I was doing my research, I came across multifamily investing and started out just doing it passively. And after doing a couple of deals, I thought, I think I can do this myself. So started really getting involved in the training and understanding and the mentorship on how to do it, and was able to purchase my first deal, which was a 100-unit property with 2 other partners. And that was in February of 2018, all the way up to where I'm currently working on my 9th co-syndication. And it's a 288-unit property that we're looking to close in the next couple of weeks. And so in those 9 deals, it gives me over 1,300 units that I've co-GP'd. And like Albert said, we're over 3,000 units, counting the passive investments that my wife and I have made.
It's a fantastic journey. It looks like you've already accomplished a lot. And you mentioned before you were a physical therapist, you have this kind of a business, like a private practice of physical therapy. And I read your bio before, and you have many years before. Like, what triggered your mind that moment that you changed to get involved to real estate?
Yeah, same with a lot of people. The Rich Dad Poor Dad book, I read that. It really shifted my mindset and thinking about money. I had the middle class mindset of do good in school, get a good job, work hard, and in retirement. Then after reading Kiyosaki's book and then some other ones, it's almost like we save enough money and we hope to save enough to where our money lives longer than we do. And so I just having that mindset of needing to find something where money worked for us and we were buying cash flowing assets and to create some freedom too. Now I do work quite a bit in real estate, but I have the freedom to, I work from home, but I can take off when I want. I can do my work from about anywhere as long as I can get a Wi-Fi connection. And so just having the freedom to not have to ask somebody for a day off or, have to be there at 8 o'clock in the morning until 5 or 6 or whatever the time is. Whereas I can, some days I can easily go to events at my children's school. I have the freedom to go, I rarely miss those things. So just having the freedom to do that was a big motivator.
Oh, yeah. I think a lot of real estate investors get into real estate because of Rich Dad Poor Dad, which is Kiyosaki. I get influenced by this like a super Rich Dad Poor Dad book. That's how I get into real estate as well. But from your intro about your story, you mentioned about single family as well, but looks like you didn't get into single family and then you jump into the multifamily directly. So why? I suppose a lot of people start with single family. Why you start with multifamily in particular? The multifamily is like a very big stuff. So
Sure. Mostly because I had analysis paralysis. I just over analyzed, never took action. My wife and I looked at, we learned about single family probably 2 or 3 years and just never took action. And amidst some opportunities where houses were for sale for very good prices, and we didn't take it. This is 10, 12, maybe 15 years ago, and looking at the price of single family homes now. So I think that is a good route, but I also think it was a blessing because I didn't end up having a lot of my capital tied up in those single family homes. So it was as I was studying, and we went to a lifestyles event, and I heard about multifamily. I'm like, wow, this is very intriguing, and thought I want to do it. But my father-in-law, who's been a big influence too, because he has a 12-unit apartment complex he's owned since the 80s. He approached my wife and I and said, hey, I heard about this Brad Sumrock guy. It's in a couple of months. And I was like, oh, I'm ready to go. I'm ready to jump into lifestyles. But I'm glad I did, because Brad is lifestyles a single family and multifamily, but Brad is strictly multifamily. So I'm glad I stuck with him, and then went through his mentorship program, through the learning, through his coaches, been able to working on my 9th deal. But I think I'd done 4, working on my 5th deal when I started coaching with him about 19. So about almost coming up on 4 years that I've coached with him, and love doing that because I get to teach other people. I think it helps me learn too, as new people are coming, asking questions, but also passing some of it along of what I was able to gain through the program.
Yeah, wow, this is amazing. And yeah, you mentioned about coaching, and my feeling, because I interact a lot with you during the deal analysis, even the deal analyzing Florida. I learned a lot from you about, okay, how to underwrite, how to project this, and then what things to look into from the financial report provided by the brokers. I really appreciate this kind of experience, and I believe you help a lot of the other students too. You also mentioned about like smaller scale multifamilies, like 10 unit, that kind of things. In your opinion, what's the difference between this smaller unit multifamily and the larger size, like 100 unit? Looks like your first one started as 100-ish unit. Like I believe there's a difference between this, and why you started right up for the large one instead of a smaller one. Because I heard a lot of people mention start with small, but it looks like in this world it's a little bit different.
No, great question. The biggest thing is around 65, 70 units, it becomes cost effective to have full-time staff. So you have a full-time office person and a full-time maintenance person. So anything below that, you're going to be, as the owner, you're going to be responsible for all that. It's just not cost effective to have full-time staff there. And so and if you look at it too, on those smaller number of units, one vacant unit hurts, one down unit or vacant unit really affects your bottom line a lot more than, if you have 200 units, one or two units, you're okay with having those vacant. But if you say you have a 10 unit and you're 1 unit vacant, you're 90% occupied. You're 2 vacant, you're at 80% occupancy. So it hurts. You're losing a lot of income relative to your units at that point. And it's less work. On my properties, out of the 9 I own, I don't have a key to any of them. I couldn't get in the properties unless the staff's there. I can manage. I try to visit at least once a month on our stabilized properties, and but from home I look frequently at our several KPIs. The delinquency, obviously occupancy, but delinquency and collections are big. What we're looking at. What a projected occupancy is going to be, and leases. I like the availability report, where you go in and look how long have units been vacant, how long have units been vacant and not ready. There's just some of the things you want to look at it to make sure the property management company is doing the job they're supposed to be doing.
Okay, wow, this is a great to hear the property management, the asset management perspective you mentioned. I believe is a super important component of the whole deals process. And so let me ask you this question. Like, I believe a lot of audience also interested in learn that, is like the asset management. How do you approach asset management to ensure the success for investment and your investors' investment? You mentioned a little bit about the PM company, the PM. So look at some metrics, but the whole process, the whole asset management cycle can have a lot of things going on. So, in general, what strategy approach, like how do you keep an eye on that? So
yeah, so we have lists of there's things that I check. I don't always check off the list, but there's things we want to check weekly, monthly, and then quarterly, and like some of the, and I don't have my list in front of me, but weekly we're looking at occupancy, where our work orders are, or do we have overdue work orders, where our collections are, like especially a week into the month, how many people still owe full rent? Is the property management company following up with collections, knocking on doors, calling, making sure these people are paying? Looking at a monthly or probably quarterly, we'll look to see how many units are on month to month, and are they being charged a month to month fee and full market rent? Are there any complaints? And then looking at our budget, or what's the budget variance? If there's anything that's significantly off, what's the explanation? Why is that occurring? And then some of the quarterly things that off the top of my head, because I have a lot of these set up with reminders, is are our funds being, because the lender requires us to escrow tax and insurance. We want to make sure that number is coming in close, because we don't want to end up at the end of the year and be tens of thousands or several $1,000s or more off that we have to come in and fund. So, every quarter we check to see where our funds are. We make sure, I look at the accounts payable to make sure we're not having anything age much past 30 days. And so those are, that's probably a monthly thing. But just look, and then we've moved from Monday to ClickUp, which is a service where we try to put, we're still getting it created and the bugs worked out, but things that we look at that give reminders, make sure you've checked on these things either weekly, monthly, or quarterly. And, it's the other thing, even there's some annual stuff that for our IRA investors, we have to send fair market values out. Usually, I think it's by January 15th, but we start sending those out middle of December. We have to get K1s together, get everything to our CPA so we can have the taxes taken care of. One of my other partners does a lot more of this, but he shops our insurance every year to see if we're getting the best price on insurance. He gets our stuff over to our tax protest professional, so we have our property taxes protested, and then he also follows up with a lender. There's I'm not involved in this, so I'm not sure exactly, but I think we have to send quarterly updates, quarterly financials to the lender. Ever so often we have to send in our personal financial information for all the GPs, but he organizes that portion for us.
Okay, so during the asset manager, you collect a lot of financial report and track metric and frequently communicate with the PM company. So from physical aspect, which means that the real property there in the local, do you or your team sometimes just or on a regular basis just go there and visit there, drive by and take a look at if the property is clean, in particular like a visual track like a.
So early on, when we're doing a lot of the CapEx in the first year and a half, we're there every 1 to 2 weeks looking on all the CapEx projects. Once the property's stabilized, we shoot to be by about every 4 weeks, 4 to 5 weeks. And most often, I don't let the property management company know I'm coming, because I want to drive and make sure they're picking up trash and drive through and check on those things. We also like to walk a few of the vacant units, just to come out and see what the condition is. But also there's a chance, and we've never had this happen, but I want to try to help reduce the odds of it happening, is that the office staff could be leasing units under the table for cash. And so we'll just pick randomly a set of, usually the ones that have been vacant for longer, and then maybe a couple new ones to see the condition, but also just to make sure they're not leasing those to somebody and showing it as vacant, but taking cash payments. And so that's a thing to check occasionally, and go out and actually shop some of the comps. We'd only need to do that at the when we're purchasing, but it's good to do that every couple of at least twice a year. And something we started this year that's actually just finishing up at our properties in Abilene is we pay somebody on the beginning to do due diligence. They walk every unit. They have plumbers. roofers, asphalt people, general contractors, air conditioners. Well, we're doing something similar now, and we may do this annually or every 2 years. We're having that one of the due diligence companies walk every unit. We won't have the tradespeople out there, but we're going to walk every unit, get the condition of them, find out if there's pets in there, if if they're dirty, if they're hoarders and things like that. But it also gives us a good report of what amenities are in each unit. And so that's something we started doing this year to get an idea of what. And so we're doing that on all of our properties out in Abilene.
Oh, cool. So yeah, another thing is like curious in mind is during your talk you mentioned about the insurance. You mentioned you shop insurance every year. That's like because those large size multifamily sort of fall into the commercial real estate world as opposed to those small residential single. That some of the Sunbelt places around, let's say Texas, Florida, in particular Florida, we are here like facing insurance skyrockets. In the commercial world, the insurance is kind of like a monopoly state, like just so little of insurance you can get high quote. And how do you mitigate that? For example, you get a quote for the property and then the insurance high, then could you still get like a lower quote from the other insurance providers and things like that? I'm just
Sure.
curious.
One of my business partners does most of that, but I'm at a distance involved. He does shop it to more than one, and we found lower prices. Now they're going up again, and like you said, right now there's very few providers in the South, and that's even in Texas I don't know the exact numbers, but our three of our properties, one went down 20 or 25%. The other two went up 25 and 32%, something like that. But we look at different providers that will go, but there are only 2 or 3, different brokers that may have different access to different providers. And so we do ask, we go and ask for different prices. Just we owe it to our investors to go and find the best price. And then it gets tricky because you may see a lower price, but then you got to go in line by line and make sure you're getting the same coverage. What you don't want to do is get a much lower price, but your deductible's astronomically high where the property can't afford it. If there is a fire, your big expenses will be fire or a big hail damage where your full roof needs to be replaced. Those are the two that really could cost you, and and also trip and fall, some of the liability stuff. But what you don't want to find out is that you don't have the same coverage, and your lender is going to require certain levels of coverage. So you got to make sure that what you're setting up is also acceptable to your lender.
Yeah, the side by side comparison is interesting because at least in the residential side, every year we requote. And then we say, oh, this is high. And then I change another agency and then say, hey, give me another quote from some other insurance company. And then I compare the liability. The quote again is not exactly, they're no 100% the same policy. Sometimes they have this and this item and another insurance company have a different item, but they sort of probably like maybe 80-70% you could compare like apples to apples side by side, but not exactly the same. Is that same here in the multifamily world?
Yes, and you got to watch for things. Are they giving you make sure that what you're being insured, because there's a cash value and replacement cost where one of them only you get the amount that that's the depreciated amount, which and the other you get what it would cost a replacement in today's dollars. So you want to make sure you have that full replacement cost coverage, because what you don't want to get 70% of what it would cost to build back, unless you have. I guess if you were going to go and have a big stockpile of cash, maybe you would be okay doing that. But you want to make sure that the insurance is going to rebuild what you have for a big disaster.
Okay, cool. That makes sense to me. And you also mentioned about there's an IRA investors, and through the Summer Ups mentorship program, I do learn that a lot of people use like a self-direct IRA to invest things. I'm also considering like probably switching to that. But could you elaborate a little bit more, deep dive a little bit more about this, the way using IRA to invest? Like, was a benefit? Was like a potential things to keep in mind?
Well, if you have it, one, to know, ask the syndicator, you can't invest in your own deals. So that's why you typically will invest that in other people's deals, because the IRS laws, you can invest. And even if your brother, it's I think it's called arm's length, but like your brother couldn't, your siblings and your mom and dad could not invest in your deal with their IRA money. So that's why it's good to go. But you got to be careful with some of the IRA setups, because there is a UBIT tax, which is unrelated business interest tax. So any deal, that tax can be pretty stout on a deal that's leveraged. So some people will move their into a solo 401k, which I don't think you can do with a Roth IRA. Maybe tricky, but with a traditional, that way you don't have the UBIT tax that could come after. So that's something to be aware of. How much you're going to be taxed on it, but it's something, what per the our SEC or the SEC guidelines, we can take up to 25% of our capital through IRA money. So it can be a pretty significant amount, and it's a great way. I've got several other coaches or other Sunrock people that have invested in my deals, other syndicators. I've invested into other Sunrock deals, not Sunrock, but other syndicators deals with some of my. We've actually cashed out most of our traditional IRA and just have a Roth left that we're going to keep, but everything else we did that way I could have that money to invest in my own deals, because when it was set as an IRA, I'd have to put it all in as an LP somewhere else.
Okay, cool. Yeah, because I'm particularly interested in this part. Is like there's like within the Sunrock ecosystem, there's a lot of deals, like a lot of GP call for LP, and then like sometimes I feel, wow, I don't have that many cash in the bank account, and then how, if I want to invest in some interest deal, how am I gonna find money? And then I already gonna be. I feel that, to me, correct me if I'm wrong, the liquidity perspective from IRA account would be a advantage, because it doesn't take the money in your account for daily cash flow, that kind of things, right?
Yeah, I think I understood your question. So with the IRA, you're not looking for cash flow because you can't use it. It's just going in there building. You really, so on IRA deals, you might look for deals that are going to give more return on the sell, not necessarily cash flow. But the counter to that, though, is you want to see some cash flow on a deal, because that means there's enough a gap between the debt payment and what the property's making that it can provide cash flow. And so that's an attractive thing. But with your IRA, does that answer your question?
Yeah, sort of. Let me rephrase my question probably in this way. Like, say, in a bank account, if I only have like 50, I just make up number. If I only have 50, then I can invest on one deal. But since IRA account or this 401k, whatever, this kind of retirement account has accumulated the money through many years, there's like a big chunk of money there inside. In that case, if there's not enough money in one investor's bank account, which do not have enough cash, IRA or the 401k, those retirement account, those account have a lot of money in, which means have a lot of capital. Then could take that money to invest in the deals.
An LP, that you could not invest that into your own deals. You'd have to invest it in someone else's deals.
Okay, that makes sense. Yeah, that's sort of answer my questions. Yeah, let's go back, step back a little bit. For a lot of syndicators, usually the first deal is the hardest one to start. How did you source and structure the first deal, the 100-ish unit, that deal you mentioned, and what were the key lessons learned from that deal?
Great question. So what I did is leveraged other people's experience, being in a mentorship program, and then building relationships with two other guys that I ended up partnering with. One was less experienced like myself, and one had more experience. And he had, I believe, 5-6 deals at the time, and was busy and had a more challenging time doing the underwriting. So as we grew our relationship with him, we just said, would you consider being a co-GP with us if we find a deal in these submarkets at this size, and we'll give you a little bigger cut of the first deal. And we gave him half the equity on the first deal. He did 2 more deals with us. On the second 2, we did equal splits. So it was building that relationship so he would we had an experienced partner. And then we also we bought in a secondary, maybe tertiary market, because we'd been looking in Dallas DFW, Dallas, and Fort Worth for a while and not having any success winning bids. So we decided to go look in some of the secondary and tertiary markets in Texas.
Yeah. Yeah, talking about this secondary tertiary market is this interesting things that trigger the question mark in my mind as well. I believe a lot of the audience could be interesting here. The DFW market is big, and I believe there's a whole lot of competition as well from many GPT to find one deals. But secondary and tertiary market may be less competition. I guess this will be another advantage for investing the secondary or tertiary market. I know you have several deals, including the deal you're currently working on to close it. Could you dive a little bit about the rationale why and the benefit, everything that why and how you do successfully investing the tertiary
secondary markets? You're right. You're not going to. There's a lot of in DFW. There's a lot of people bidding on properties. All the major markets. There are fewer people bidding on deals in the secondary, tertiary markets, which means you're going to get a better price. It's not going to bid up. Now you got to know that you have to project that it's not going to sell us a high. Drop the same property in the DFW. It's you can project selling it a lot more. But I will say what we've experienced in our secondary, tertiary markets is we've had nice, steady incline improvement, whereas some of DFW you can shoot up and level off. But one of the biggest thing that I've learned and because I have properties in Houston and Dallas and Arlington, Texas, as my secondary markets, we have a lot less delinquency. Our occupancy is higher, but the delinquency is the biggest thing, and that is non-paying tenants. So there in our secondary markets, we have a few $100 to $0 at the end of the month for every property. Occasionally, maybe $1,000 to $2,000. Some of our Houston and DFW properties, we have $10,000, $20,000 at the end of the month. It's just a different mindset of the demographic to pay. Plus, the courts are a little more conservative, so they are more letter of the law, and people get evicted quicker, more timely manner. So that lets them know if you don't pay, you're going to be evicted. That's not our goal to evict people. If somebody's having a challenge, we're going to work with them. Now, if they have a challenge every month, we may not work with them all the time, but it's our goal to get our tenants to be able to pay and have a place to live. But in the end, if they can't pay the rent, we have a responsibility to our investors, and if we let everybody stay that didn't pay, we eventually wouldn't be able to pay our mortgage and our utilities and all the things that the property is responsible for. So we have to have paying tenants in the units.
Yeah, this is the one aspect that I like for the multifamily business, like they help people to help accommodate and to help they live in a place comfortably and improve their quality of life, essentially helping the whole community, neighborhood as well. Yeah, that's great. And actually, I would like to connect a little bit back to your physical therapy background a little bit, because this is interesting. Like your background previously as a physical therapist, like a manager of the company you run, like I believe we can add that a unique dimension to your expertise and the team management, those kind of experience, how that experience in healthcare influence your approach to managing teams in multifamily and asset in real estate, how this can all connect together, influence.
No, good question. It carries over because part of the therapy is motivating people who may be in pain or not feeling well to get up and move, to do their exercises, to improve. So that's motivating our staff on these properties is I think is in being sure to encourage them and not speak harshly with them, but use encouraging words, treat them as a person and, just really try to build them up. And we like using incentives, having bonus structures for hitting certain goals and milestones so they have a carrot out there to help draw them to where they can, earn a little more money if they hit certain goals, get them to stretch a little bit for things that we need.
Well, that is very smart incentive to the employer contractor or the PM team you hire. I really like that approach.
Yeah, that's great. So, in setting up incentives, we did a neat thing. I learned this from another one of my peers is we did a contest between all our properties in Abilene, who could get the most 4 and 5 stars for their property in over a month. And then we took them all out to that, whatever property one got to pick where they wanted to go to lunch. And the ownership took them out. So we got a lot of, every property got several good reviews and increased their Google ratings. So, doing things like that are, I think, encouraging.
Okay, cool. Yeah, and actually during talking, my mic flipped up a little bit to the Abilene because I know you're doing is that your nice or deal you're currently working on in the Abilene market.
Correct.
So
Yeah,
probably you could dive a little bit why you like that property. I know you already have some property there, and then how this one and that more success on top of the portfolio you have there happening. I do check that the rent growth, the market, is very steady in that market. It's not like the other Sunbelt places, not like Florida, major metro, not like Dallas. There's like a big bump. It's steady during the COVID pandemic. Currently, it's still like a trend of continued steady, like a straight line growing. So
that's what we like. It's just been nice and steady. But having 4 other properties there is we know a lot about the market, and we own 2 properties just across the street that have maintained 96% or better occupancy over almost 2 years on average. And so we know what can be done there. The property we're buying has been in the low 90s. So if we can get it up to 95 to 97, that's more income we can make. We can come in and run it more efficient. With us having, I think we'll have 517 units in a 1-block area. So with that way, we will, one, be able to share staff, which will help reduce our staffing costs some. We'll be able to use leverage our numbers for vendors. So like our landscaping, we can say, look, you've got 500 units right here within a block. You barely have to move your trucks. We need a better price. And, plumbers, as we have more units, we can get better prices on all our contract services and things like that. And then, the biggest thing is staff too. If you only have one property somewhere and somebody's sick, you either got to bring a temp in or the regional has to fill in. But with us having enough units there, we're going to have 5, 6, 7, 8, 9, 10, 11. I think we'll have about 15 employees around in Abilene. So somebody can move over and help ask you to. And we have a really good HVAC air conditioning guy who saved us a lot of money because he could fix air conditioners that we might have had to replace. We're working on having him oversee all the properties through the summer when air conditioners are breaking. And so that'll save us a lot of money where we don't have to spend $3,000 to $5,000 on a full air conditioning unit. We can pay his hourly service and maybe some materials and, just spend a few $100s to repair the AC units. So things like that, having that scale of multiple, several hundred units within a tight area. We're going to have over 700 units in a 5-mile radius and then 500 within a 1-block area.
Wow, it looks like you have a really solid team there and a solid, good sized team there. And I feel that the effect of economic scale is really strong there. So that, I believe, feel your investors and the people interested in your deal are going to feel, oh, that's good. So, yeah. All right. So, yeah, let's continue. There's some interesting question on the pipeline for today's interview. This one probably is about the market and how you deal with market in general. Like in the dynamic world of real estate, the trends and market are ever changing. Strategically, how do you stay ahead of the curve and ensure your strategy remain effective and profitable? Is that like not just specific to today and in general, like among your 8 years experience, like what you experience, what did you try and learn, like that kind of things?
I think some of the best is being part of a ecosystem, our coaching group and then the wholesale market group. Our coaches, we meet twice a month to talk about what we're seeing with deals. So that gives us a good idea. And then the coaching, the overall mentorship program has a call a Zoom every 2 weeks, or first and third week of the month, maybe second and fourth, but twice a month that we have calls. But then also going to some of the different meetups and things and talking with other owners and reading some of the stuff that's coming out and attending some of the conferences where they talk about trends and the data that's coming up. So, staying up to date with the industry data and writings, but also talking to people who are out there living it, doing it every day.
Yeah, I love data and like to talk about data with people. I'm the data guy. I always
Yeah.
pull the data from different sources and to take a look at, okay, what would be the trend and some influential factor. I believe analyze those influential factor. We're gonna be able to forecast a bit for the future, like near future, or maybe long term is hard, but at least near future, 1 year, 2 years ahead, like would be feasible with a lot of this. Like, okay, people share idea together and gains and learn from the data, discuss the data together. Okay, this is going to be relevant. Then what do you see the opportunities for multifamily syndication in the coming year? That's probably about a little bit forecast. For example, 2024, 2025, this is like near future.
I think, we're in a downturn in the market right now with inflation going up and trades have slowed down. But there were a lot of deals, probably the majority of deals that sold in 2021, early 22 were short-term bridge loans that are coming due in 24 and 25. So there are a lot of owners that may have to sell to because they can't extend their bridge loan, because in that same period, interest rates have risen faster than they have in over 40 years. So not many people, if any, were factoring in that, when they were going to exit these deals, that their interest rate going into a new debt right now is probably going to be 6.5 to 7. Now in 24, 25, that may come down. But if you're trying to get a new loan today, you're going to be somewhere between 6.5, 7% interest and an LTV of only 60, 65%, which makes it hard if you did a bridge loan in 21 at 80% leverage and a 3 or 4% interest rate, you're going to almost double your interest rate and lose, 15, 20% on your loan to cost.
Yeah. I feel there's a lot of the cases for among a lot of the GPT, like back to the pandemic period, like there's interest rate low, and some of them even didn't buy the rate cap or didn't buy low enough rate cap, and then coming to the situation that the property is kind of a distress and have to sell or hard to be refinanced. But do you feel like the rate could go down in about like say 2 to 3 years? Things like that.
And not having a crystal ball, but if you look at most of the projections, they will. But I will say that back in 21, if you're looking at the projections, one of my partners sent me a podcast from 2.5, 3 years ago, and it showed that they thought the high would be LIBOR or SOFR would be at 100 basis points, and 2028 would be the high point. And here we are, and I think SOFR's over 5. I haven't looked at it in a few days, but it may have come down. But it's 5.5, I believe, last time I looked.
Okay. Yeah, it's hard to predict. It's like, but yeah, probably we just keep an eye on it, like for the deals, each of the deals, the structure, probably build enough buffer, or probably get the really appropriate like a debt structure for the property. So, because talking about this recently, I do see some of some rockers getting the deal, really large deal, like with the bridge loan, like floating rate, but they buy the rate cap really low, rate cap at 4 point something. I don't remember the exact number. It looks like a good, decent rate cap, and they bought it for 3 years. Looks like that might be a kind of a good structure. 3 years based on historical Fed's like increase the decrease rate pattern, that the rate would be decreased, right?
Yeah, it should. But 70s, 80s, we had double digit interest rates at one time in the past. That gives me concern. I think everything points at a floating rate could be more advantageous now as rates come down. But you do have the risk that they could run up.
Oh,
you
then
can
that
also
would be
buy your interest rate cap just slightly above where you're at, or somewhere to protect yourself. But if they run up, that's what's happened with all the deals that are coming due in the near future. Is people are expecting interest rates to not rise very much, and they rose at near historical levels.
Okay. Yeah. Let's see. All right. So yeah. Next question is, what can people expect to see from your business in the next 2 to 5 years? Yeah, like your blueprint, your roadmap.
Well, we're looking. We're still like we're buying a deal now. We'll keep looking. I want to, we're coming into the holiday time, so we'll not be do anything over the next month or two. But early next year, we'll still underwrite. I think right now, just looking, it is a little more challenging to raise capital at this time. So looking at smaller deals where we don't have quite as big of a raise, and continue to look at deals in secondary, tertiary markets, and even in DFW, and watch for deals that may have challenges and need to be sold for quickly sold for to help somebody to get out of a deal.
Okay, so all of the market mentioned here looks like all the Texas market. So do you ever thinking about expand your search or hunting in the other states, say Florida or some other Sunbelt, whatever state?
I'd want to have somebody local that would do it. I live in Texas, so I drive to my furthest properties 4 hours, four and a half hours. So I don't see any reason to do something where I need to fly. Unless somebody has a partner, I could come in and be the experience on the team and not have to be there. As even my Houston properties, we try to get by every 4 or 5 weeks. And so that's a 4-hour drive, which can be a challenge. It's not a bad drive, but I don't have to get on an airplane, pay the money for that, stay in a hotel and to travel to see them. So, being in Texas, I don't see any reason to aggressively find stuff out of state, but if a nice opportunity came up, I would definitely consider it because, Florida, Alabama, Georgia, Arizona, there's, some of those markets have really done well, have a lot of growth also.
Yeah, cool. Yeah, it looks like you have a solid plan for the near future and then probably a little bit longer future. So is that the question probably about the books? Because I like read book and a lot of syndicator also like read book. What books that you recently read stand out in your mind?
I'm actually reading one right now called Get Your Life Back by John Eldredge. It's not really real estate related. And the one before that, because we'd done a trip when one of my daughters was in a competition in Chicago about the great Chicago fire, where a lot of the downtown area of Chicago burned down. And then this one's on Why We Sleep, but going over the importance of sleep. That's just a health book. And I think what am I thinking of? The Gap in the Game is probably the last good one that was really good. I don't know if you've read Dan Sullivan books, but this is a good book about we don't need to get stuck in the gap, like thinking about the negative, thinking about the positives that come out of things. That was a really little life change. Kind of got my thinking different book.
Okay, well, those books seems interesting to me too. It's like in particular those about how to improve the sleep quality. I like to dive into that book as well because sometimes I have a sleeping problem.
It really changed my mind because forever I thought I only needed 6 hours of sleep a night, and I did that for a lot of my life. But this book goes and talks about how important a good solid night of sleep is.
Exactly,
almost that sleep deprivation is more unhealthy than smoking cigarettes. It kind of type thing. That's that studies have shown that sleep deprivation leads to all kinds of negative health effects.
Yeah, I'm with you because I believe that sleeping they impact energy and energy can impact everything. This is what I learned from the recent Tony Robbins Unleash the Power Within UPW event. So I'd love to read that book. Thanks for sharing the book you're reading.
Yeah, well, once you read it, let me know what you think.
Cool. I will do. So, the last thing, what's the best way for audiences to reach out to you and to learn more about investment strategy or business, etc.? Like, what's the contact they can reach out?
Sure. So I have my email is Nic, N-I-C, there's no K, at flexequitygroup.com. So Nic at flexequitygroup.com. And then also have a Calendly link that is Visit with Nic. So VISITWITHNIC. Visit with Nic without a K. If they want to book a Calendly, a 15-minute get to know you call.
Cool. Yeah, I'm gonna also put all of this contact information down below the YouTube video so that the audience can feel free to reach out to you.
Please.
Wow, this is a great interview. I appreciate that you share so many great information and spend the time with me and my audience today. And thank you so much. I feel so grateful. And your growth in multifamily business has been so astounding. Coming to working from a 9 to 5 workers and going to where you are now. So, and you haven't looked back ever since. So this is such a great, outstanding achievement. And thanks again for spending time with me and my audience. Really appreciate it.
Hey, thank you, Albert. I appreciate you asking me on and I had a great time today. Appreciate it. Look forward to when it airs.
订阅 ACMG 资本团队邮件，关注高回报公寓楼投资。